What does it mean to behave like a long-term investor? A behavioral and strategic perspective. Being a long-term investor is not about holding assets for a long time by accident. It is about thinking, deciding, and behaving differently from the average market participant. Long-term investing is less about time horizon alone, and more about psychological structure. 1. Thinking in decades, not days. Most investors focus on daily price movements, weekly volatility, monthly performance. Long-term investors focus on 5, 10+ year business value, structural economic growth, compounding over time. As Warren Buffett famously suggests, if you are not willing to own something for years, short-term price changes should not dictate your behavior. Time horizon changes perception. Short-term volatility becomes background noise. Long-term value becomes the signal. 2. Separating price from value. Price fluctuates constantly. Value changes slowly. Long-term investors evaluate business fundamentals. Focus on earnings power and durability. Avoid reacting to temporary sentiment. This distinction is central to value investing traditions developed by thinkers like Benjamin Graham. Behaviorally, this requires emotional detachment from daily market moves. 3. Reducing myopic loss aversion. Research by Shlomo Ben-Artzi and Richard Thaler demonstrates frequent evaluation increases perceived losses. Perceived losses increase risk aversion. Increased risk aversion reduces long-term returns. Long-term investors deliberately reduce price check frequency, reaction speed, impulsive adjustments. They design their environment to minimize emotional interference. 4. Preferring process over prediction. Short-term investors often ask, "What will happen next?" Long-term investors ask, "Is my process sound?" They focus on asset allocation, diversification, cost control, consistent contributions. This philosophy aligns with passive investing principles promoted by John C. Bogle. Prediction is fragile. Process is durable. 5. Tolerating temporary discomfort. Long-term behavior requires accepting market downturns, volatility, periods of underperformance. Psychologist Daniel Kahneman showed that losses feel roughly twice as painful as gains feel pleasurable. Long-term investors train themselves to tolerate this asymmetry. They understand volatility is not a bug of the market. It is the price of long-term returns. 6. Lower activity, higher intentionality. Long-term investors typically trade less, check portfolios less, react less, but they think more deeply about risk capacity, strategic allocation, structural trends. Lower activity does not mean lower discipline. It means fewer impulsive decisions. 7. Defining success differently. Short-term mindset measures success as beating the market this month, avoiding every downturn, capturing every rally. Long-term mindset defines success as staying invested, avoiding catastrophic mistakes, letting compounding work. Time in the market outweighs timing the market. Practical signs you're acting like a long-term investor. You have a written investment plan. Review periodically, not daily. Rebalance based on rules, not emotions. Continue investing during downturns. Ignore short-term noise. If your behavior changes dramatically because of headlines, you are still operating short-term, regardless of what you tell yourself. The core insight. Being a long-term investor is not about how long you hold. It is about how calmly you behave during uncertainty. Long-term investing is structured, process-driven, emotion-aware, low-frequency, compounding-focused. In the end, the biggest advantage of a long-term investor is not intelligence. It is emotional stability and behavioral discipline.